Welcome back, slackers. Sorry to call you out like that, but it's tax time again, and many of you are wanting to know, is there anything I can do to lower my tax liability? Well, stay with me. I've got 10 things that we'll go through pretty quickly here, some for business, some for individuals, and then we'll go through this pretty quickly. There are things that you can do in many cases, and so we're just going to go through that. So number one, if you have a high deductible health plan, fund your HSA. Yes, last year is over, but you can still fund your HSA all the way up until the filing deadline of April 15th. How much? Well, if you're single, $3,850, and if you're married, $7,750. And if you're over 50, you can do a $1,000 catch-up. So if you're in a 22% tax bracket, that could save you up to $2,500 on your taxes. That's real savings, and that can be done between now and April 15th. Even though you're funding for last year, we can still get to deduct it this year. That's pretty cool. Now, if you're single and you fund the full amount, that can save you almost $850. Once again, real money. And it's money that's going to you. It's in your HSA to help offset your medical expenses. And if you don't use them later on, we can even convert that into a Roth. So it's a really good opportunity. If you haven't done it, take advantage of your HSA. Very cool tool. Number two, IRA. Very similar concept here. We have until April 15th to fund your IRA. Once again, we can fund it this year and deduct it from last year's taxes that we're about to prepare. That's pretty cool. How about you small business owners out there? Here's a good one for you. Bonus depreciation is being phased out. It was 100%, and now in 2023 it dropped to 80%. But never fear, we can still deduct using Section 179, write off the equipment of up to $1,160,000 in 1 year. Now, most of you aren't going to have that much equipment, but if you do say buy a large piece of equipment, we can still write it all off this year, and that's a decision we can make all the way up until the time we file the tax return. So this one can go even past April 15th if we file an extension. If it's a 1040, we have all the way up until October 15th, and if it's an S Corp, we have up until September 15th. So we have plenty of time to compare this year as well as last year to decide how we should handle this, and it's a beautiful deduction that really does help a lot, and I'm glad that we still have that opportunity. Number four on my list, home office. Now, unfortunately, for those of you who have a job as a W-2, home office expenses have not been deductible since 2018. However, if you're self-employed, they still are. So if you haven't used the home office deduction, make sure to sit and talk with your tax preparer because it can be a good opportunity. And I'll be honest with you, me personally, I actually don't worry about the home office deduction as much from a deduction standpoint as I do from establishing a home base for my business so that I can begin mileage as soon as I head out to go visit a client. In my mind, a lot of times that's way more beneficial than the few $1,000s of deduction we may get for home office. So if you haven't done that yet and you are self-employed, really work on trying to establish a home office that's dedicated so it will pass all the IRS tests. If you have any questions on that, let me know and we can discuss that potentially in another video. Now, in addition to the traditional way, several years back the IRS also passed what they called a safe harbor. And for those of you who maybe don't want to be as aggressive on your home office, but we really want to still get that deduction and establish the home base for mileage, the IRS has pretty much said if you go with the safe harbor, we're probably not going to bother you. And how that works is it's $5 per square foot up to a maximum deduction of $1,500. A lot of my clients are going that route just because it's cleaner, there's not as much paperwork involved, and they're still basically getting as much as they would the other way in a lot of cases. So if you haven't looked at that, awesome thing that you can do. And once again, we can wait till all the way till we file the tax return to do this. So last minute deduction, really in your favor. Okay, moving right along. Got a couple here more for business, then we'll get back to some for individuals. So stay with me. Number 5, I have SEP IRA. So if you're a self-employed person, maybe your friends that have jobs are getting to use a 401k. You thought 401ks are too expensive for your small business, and maybe they are, maybe they aren't. But a SEP IRA, you can fund all the way up until you file the tax return, which gives us a lot of time, and it's perfect for those of you who just haven't gotten around to tax plan. But we can fund this right before we file the tax return as long as we file timely. So we have plenty of time on this to prepare the return, see what the numbers are, and see what kind of benefits you're going to get from it. If it's really going to do well, then maybe you should consider funding a SEP this year, especially if you're in a 22, 24, or even higher tax bracket. You can get a really big bang for your buck. The SEP is normally going to be, I think for this year it's around $66,000 is the max, and it's just a percentage of your profit. Really good deduction, fairly cheap to administer, so you get to keep most of your money instead of paying someone else to do it for you. You still have to get a financial advisor or a bank or somebody to handle the SEP, but it's a really inexpensive way to start saving for retirement. And if you haven't started doing that as a small business person, you really need to think about it, because there's going to come a day when you're not able to go out there and work anymore. So don't let this pass you by. Take advantage and make sure you talk to somebody about this, because I really like the SEP IRA. It's a good way to get started saving without getting too sophisticated. Number 6, profit share in a 401k. So maybe you've decided that you've outgrown the concept of the SEP and it's not the right fit for your business, and a 401k would be. But you're like, Doug, I'm a slacker. I didn't get my 401k set up last year. That's okay. They've made the rules now so that we can set up that 401k and we can still fund all the way for last year on the profit share side. Now there's a lot to this, so it's not the video for that, but I just want you to be aware of it. If you're a small business owner who didn't quite get to setting that 401k up for last year, you still can. We can get it started. We can fund the profit share this year, and then we're ready to start doing the deductions from payroll for you and your employees going forward. So that's something a lot of people aren't aware of. It's a really cool thing that came out of the Secure Act a few years ago, and I don't want you guys to miss out on it or think it's not there. So take a look at that if you haven't done that before. Okay, last one here. It's number 7 for businesses before we move back into some individual topics. And that is unreimbursed business expenses. You'll often hear about them called UBEs or UPEs, same thing. So what is this? This is for those of you who are involved in a partnership. And a partnership is different from an S-Corp, obviously, and it has a lot more flexibility. And one of the really cool things about that is you can now deduct, and you have been able to for a long time, but you can deduct your personal expenses that you pay on behalf of the partnership out of your pocket on your personal return. Now, why would you do that? Well, there's a lot of reasons why. Maybe in your partnership, the way you get paid, you generate a lot of your own revenue through marketing, through entertaining clients with meals. Now, once again, entertainment's not deductible, but meals with clients are, or prospects, and a lot of different things. Or maybe you're frugal and you drive a cheap car, and your partner, he thinks he has to have the latest Tesla or BMW or whatever, and he spends a lot on his business vehicle, and it would just cause a lot of fights for your partnership. So therefore, what you do is you make sure that your operating agreement allows you to do unreimbursed business expenses, and those expenses you can pay for yourself and still get to deduct them. That's a major, major benefit that employees don't have, but as a partnership, you can do that. And that's a really cool thing. So if you've never looked into UPEs or UBEs, wonderful if you're in a partnership. So don't let that one slip you by. Those are expenses you can turn in when you're doing the return. So yours already closed, but you can still go back through and add up all your expenses from last year and get that deduction. And for some of my clients, that can be $50,000, $70,000, $100,000 of expenses they're paying for themselves. And that can make a massive, massive impact on your tax return. So once again, another great deduction for my slackers out there. Okay, number 8, back to my individuals again. The FSA, a lot of you have a flex spending account through your job. And those are really, really cool, but as you know, they're a spend it or lose it. I don't think I said that right, but you get the point. So the way that works is if you don't use all the money up by the end of the year, it's gone. And so if you allocated $2,000 for medical, you only had $500 you spent, too bad, too sad, it goes to the cost of the plan and you lose it. However, a lot of your plans, and you may not know this, but a lot of your plans will have a grace period, and that grace period can be up to 2.5 months. Well, here we are in the middle of February. If your plan allows that, you may still have almost a month left to deduct those or use those expenses. So maybe you've been putting off going and getting a new set of contacts or eyeglasses or root canal or whatever it is you're putting off. You may still have some time, so check with your plan if you didn't use it up all last year, and that can help you not be in the lose it category. So a big deal, a lot of us weren't aware of that, and I want to make sure you don't lose out on money that really was yours to start with. So make sure to check on that if it applies to you. All right, number 9, education credits. While I'm kind of cheating on this one because you really can't go back to last year to incur expenses if you didn't already go to school. But a lot of people forget that they can get that credit, or they think that, my child's 20, they went to school, maybe I don't get that credit anymore. Now there's a lot to that, but as long as you're providing over half of their support, most likely you still can. And the one thing people don't always realize is, well, I didn't pay for it out of my own pocket. I understand. But if there was money being borrowed to pull that off so that they could go to school, you probably still qualify for that education credit. And if it's the American Opportunity Credit for the first 4 years of undergrad, that credit's up to $2,500 per student. So that's a lot of money, and over and over I've seen where people just thought they couldn't do it because they had to borrow money. Don't make that mistake. This is a big credit for you. And then there's also the lifetime learning credit, which is 20% of the first $10,000, even after the 4 years. So don't think that just because you've borrowed money you don't qualify. That's a credit I don't want you to miss out on. Number 10, very similar to the education credit, is the energy credits. Now obviously you can't put an HVAC system in last year if you didn't already do it. But sometimes we forget that we did these things because we put it in last February and we forgot that we put in a new geothermal system, or maybe we put in a new heat pump and we didn't think about it, or a furnace, or we installed windows or doors or had insulation put in. These credits are a pretty major deal. You don't have to just do solar panels to get a credit. They've actually been improved. So make sure you go back and think, did I do that last year? Because sometimes we forget. I don't want you to lose out on those credits. Now I know if you went and bought a new Tesla or an EV, most of you guys are going to remember that. But sometimes the smaller things we can forget. So I don't want you to miss that credit. The EV credits are there for you to take if you did them. So don't let that one slip by. Okay, now this one's number 11. So it's not really a break for you slackers at all. What it really is a reminder. So many of you, and I see it every single day when I'm doing taxes, are not taking advantage of the 401k plan where you work. If your employer is willing to give you money, basically, if you'll just participate, why are you not taking advantage of that? They're trying to give you 3%, 5%, 6%, whatever it is. Make sure you're at least putting in as much as they're willing to match. You may be young, you may be strong, you may be healthy right now. There's gonna come a day when you wanna retire and you're gonna say, wow, I really wish I'd have listened to Doug all the way back in 2024 when he said I'm gonna wish I would have listened to Doug back in 2024. Go ahead and fund it. Start right now. You can't do it for last year, but you can go into work on Monday and say, hey, I want to start contributing to the 401k plan. Do it. Don't regret it. We're all getting older, so that's just a little advice. Do it. Don't stay a slacker forever. So hopefully this has been helpful. If you're a slacker, hey, been there, done that. If you're not, hopefully this is helpful for you guys too. We look forward to serving you guys again this season, and have a wonderful rest of your day.